Everyone talks about what to look for in a deal. Today I want to talk about some red flags or what not to look for. So if you're looking at a property and it's advertised as a great deal, huge upside, whatever the case is, value add, maybe the rents are low. We've all seen listings like this before. That could be fantastic. And I'm sure if we were to look at enough properties at the auction, we'll find some phenomenal deals. Deals that are maybe $20 million, but if we pay cash today for $10 million, we get them for 50% discount. That's fantastic. Here's the issue with that. A good deal for you is not a good deal for me, is not a good deal for Jeff or Sam or Mike or whatever. A good deal for you is a good deal for you. It's a deal that you can put together and know that you're going to be in a good position, a better position than what you started off with. So just because a deal has 100% financing, that doesn't necessarily mean it's a good deal. Because what if it's 100% financing, you've guaranteed everything, and you're in negative cash flow? Well, sure, you just bought a 20-unit building without a penny out of your pocket, but every month you're losing now. That doesn't make any sense. The LTV is very, very important, but cash flow is even more important. So I would rather put 10% down and have my debt coverage be like a 2.1 than get 100% financing and barely cover the debt. Now, when I talk about the debt coverage at 2.1, let me go back and cover that a little bit. I would rather put money down on a deal and have it cash flow a lot stronger, 2 times what I'm getting. So if the mortgage payment is $3,000, I would rather cash flow $6,000 knowing that I put some money into the deal. That's okay. If I don't have the money, now's the time to partner up maybe with investors, use some strategies that'll work for them, whatever the case is. So, and another warning sign to look out for, if a deal is barely working and you know if the interest rates go up just a little bit, that is not a good deal. You got to be very, very careful of that. If there's another deal that you're looking at and maybe the rents haven't been raised in so long, that's also something you should be worried about. Because many times it's, well, the rents are so low, that's fantastic, that's great, but what else is there? What else is going on? If the expenses are too high, look at everything that's going to make sense for you. And if you are wholesaling the deal, you're flipping it to someone else, make sure those buyers are on board. And don't really get yourself into too much risk. That could be very, very dangerous. So be careful of too many red flags. Right now, you're going to start seeing a lot of things popping up, and they're going to say value add or something to that effect, to where it's going to be a promising endeavor, but really just be cautious and be careful, and maybe get an opinion from a few people. Maybe look at what you can do with it. So it's something you don't want to be stuck in. You don't want to get into a deal because it's very hard to get out of a bad deal. And that's something nobody really talks about. If you're in a deal and you bought it maybe a couple years ago, let's just say it's a 10-unit apartment building, something small. If that doesn't cash flow very well, that is not very attractive to an investor. So I've had to sell many properties that are not exciting. And it is very, very tough. So be very careful that you're into something you can get out of. And that's very important. So I hope that was helpful. Thank you so much.